Episode 197 of Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crudelli sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crudelli.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we get started, I want to thank all of our sponsors: CME Group, Trading Technologies, RJO Futures, and Top Step Trader. So without further ado, let's dial into those top moments of the show this month. Now, you spoke about the Fed, and I'm wondering, do you think 3 or 4 rate hikes are what we're going to see this year?
4 for sure.
4 for sure.
4. They're crazy if they only do 3. With the amount of growth in this economy, I think we need 4. I think 4 are long overdue. Give me 3, possibly 4 more next year. Let's get back to normal on interest rates. There's so much growth in the economy. Fear that you're going to choke off the growth by raising rates 1 to 2 percentage points. That's absurd. Think about it this way, Anthony. You can still go out and get a 30-year fixed rate mortgage at near, not exactly, but near the all-time low. In fact, it costs you $477 per month for every $100,000 of mortgage right now. That's just pulling the rate off bankrate.com. So think about it. You could go out and get $1 million worth of mortgage, and it would cost you 10 times that, or about $4,700 per month. And then you get a deduction. If you're in the top bracket, that's good for about 30%. In other words, your after-tax cost of borrowing for $1 million worth of mortgage is like $3,000 a month. That is so low. Maybe that's irresponsibly low. So my point is, you're not going to derail the power of this economy by taking Fed funds from 175 to 275, because even 275 is still crazy low.
Okay, so where do you see the 10-year rate going from here? Obviously, you think the rate is going up, but how high do you think it's going up? And also, if you think that we're going to have 4 rate hikes this year and potentially more next year because we have a good economy, do you believe that if rates are going up at that pace that will hurt equities?
So right now we're in a period of adjustment on trying to process what higher rates mean, because the higher rates go, the higher the discount rate, which means the less you're willing to pay for future cash flows. So that's what this correction has been about, where we went from trading at 18.5 times to effectively 16.5 times earnings. We had to adjust for the fact that rates are going up. So I think part of the pain has already been felt. Right now, the 10 years at 282. I think we're going somewhere between 3.25 and 3.5.
Real quick, in what time frame from 3.25 to 3.5?
Let's see, what month is this? It's almost April, so call it by year-end.
Year-end, okay.
Yeah, fine. Another question, but I got rambling. What was your other question? I don't remember.
Oh, the other question was, do you think that if we see 4 rate hikes this year and more rate hikes next year, will that impact equity prices?
Only marginally, because we've already sort of discounted it.
Here at FIA, you've been talking about the importance of making it easier for people to access data. We've talked a lot about that today as well. So how are you doing that and keeping the costs down for your customers?
Sure. So if you look at traditional market data delivery, it's typically been, you take an entire feed and you have to process it all. Using, dedicated lines, leased lines, all of which is very expensive. We introduced several years ago a product named Barchart On Demand. And over the years, we've moved more of our services to the cloud. And that has allowed us to provide very scalable, very flexible delivery of market data. The key technical term is web services. So we provide a collection of web services APIs that are very lightweight, can be integrated very quickly and very easily. The other main advantage is the pricing model is very flexible. We don't have to give everybody all of the data. Firms and individuals could query our system, query the Barchart on-demand platform for only the data they need. If you only want T-bond data, you could query for T-bonds. If you only want crude oil data, you could query for just crude oil data. You could query for everything as well, but if you're limiting your queries, we could limit our pricing. So that gives us a flexible pricing model that we could provide to people that don't need everything on the feed. In addition, you could query the data when you need it. So, there's a big difference between a streaming data feed that's tick by tick, constantly flowing to your servers, and there's certainly a need for that. But there's also a need for, this on-demand type of product where you could request data only when you need to use it. And the technology that it's backed up by, web services-based APIs, those are really the easiest thing out there to work with today.
All right, I want to stay with you, Ira. You've already mentioned Fed Chair Powell, so I'm curious, what are your thoughts on the job he's done thus far? I know it's only been a short amount of time, but I'm also wondering what you think we'll continue to see from Chair Powell and if he's made any impact on the markets.
And I wasn't an early fan of Jerome Powell for certain reasons. Of course, it was, his response to a question I asked him directly back in 2016 about, his response was that Europe had a printing press. But I think I like the fact that he seems comfortable not setting policy based on the most recent action in the equity markets. I can't stand when central banks react to daily changes in equity markets because it's insanity. That's the leftover from the Greenspan, Bernanke, Yellen days when they were terrified of what markets did. So I'm glad that he's more comfortable with that. Outside that, I just don't, I don't have a handle on it yet. I'm more concerned just about what you talk about. Powell's a financial guy. He's not an academic. So is he concerned like we are about the flattening of the yield curve? And if he is concerned, then I think we're only going to see 2 rate rises this year because the long end is not reacting to too many rate rises. It's reacting to the fact, it is rate rises. That's what's flattening the curve because they think the Fed's going to be too aggressive while, as Peter has magnificently talked about for the last 12 months, quantitative tightening in the system. That's what's, to me, leading to the flattening because they're squeezing the short end. We see LIBOR, for whatever reasons, going up. And the long end is going, well, maybe the Fed is moving too aggressively here between the 2 components, raising rates while quantitative tightening. And then I'll let Peter finish from there.
Yeah, no, I agree with that. And I think, for the last 2 cycles, at least, rate hike cycles, it paid to flatten the curve because the market knows where this is going to end up. On the data standpoint, on Friday, the global city surprise economic index went negative for the first time in a couple of years. So there's been a slowdown in global growth. Plus, you throw in the economic uncertainties with the tariffs, and it makes perfect sense to flatten the curve. Now, that said, we're seeing this flattening, but still the general rise in rates is higher. Even today, we've seen how choppy the equity market is this year. The 10-year yield's still up almost 30 basis points year to date, even with all these concerns, even with the potential for a growth slowdown. So that tells me that there's a new complexion in global interest rate, in U.S. interest rates, and how they're responding to what's going on here. I think that tells you that, this debate of, okay, when's a 10-year going above 3%? Well, to me, it's inevitable because they've only been able to take the 10-year down to 278 here, 275 at the bottom. I think that's a telling thing.
Well, it's great to have the 2 of you on the show today. I'm really excited for this show today, not only because I get to speak to the both of you, but this is a new format that I'm trying out on Futures Radio Show. I wanted to have two guests on that both believe in technicals and fundamentals, but one that focused more on fundamentals and one that focuses more on technicals. So, Anas, you primarily focus on the fundamentals, but you also believe in technicals. And then Tracy, you and I have talked about this many a times on Futures Radio Show before. You primarily focus on the technicals, but you also watch the fundamentals. So in today's format, I have a few topics for you guys. I want to hear from Anas first. I want to have him give us the fundamental outlook on the topic. And then we're going to have you come in, Tracy, and tell us whether or not you see the fundamentals that Anas is talking about hitting the tape, and if it's basically agreeing or disagreeing with the technicals, or you don't see the fundamentals impacting the market at all. So the first topic I want to talk about is something that I've seen both of you recently discuss on Twitter, and it's this yuan-denominated oil contract. So Anas, kick us off today. What are your thoughts on this yuan-denominated oil contract?
Okay, the main issue for any oil contract priced in non-dollar is whether the oil will be priced in that currency. So here is oil in China priced in yuan. This is different from just getting paid in yuan. These are two different things. My view is that oil is and will remain priced in US dollar. And what we see in China today is just the equivalent of that price in yuan. To make it clearer, for example, when Saddam Hussein in Iraq tried, supposedly there is this conspiracy theory going on that whatever happened in Iraq because he wanted to price oil in dollar. No, that was not the case. All he asked for is to get the revenues in euro. So the pricing in the world remained in dollar, but he get the revenues in euro. What we see in China today is exactly the same. The revenues, in a sense, in yuan, but oil remained priced in dollar. So this is really the main difference between what I believe, and I think Tracy believed too, and the others, is that we believe that it is just kind of using the exchange rate to get another currency, and that's it.
Tracy?
Yeah, I agree. I mean, there were a lot of things going on about how it was correlated. You know, it had a gold option in it and things like that. And it's simply not true. It's a physically delivered contract. There's not any gold related to it. You know, when they talk about the price of this yuan-denominated contract, they translate it into dollars anyway. Else you have no reference of what it's priced as. So everybody's quoting it in dollars anyway, even though it's trading in yuan.
So Tracy, has this had any impact on WTI? And if so, what have you been watching in this yuan-denominated contract?
My first initial thought was they were going to try and sink the oil price. And I ended up being right. Short term, I mean, you know, it was for a swing trade. And if you'll notice, the day that it opened, I was trying to look for technical areas where I could take a swing short. And so that's kind of how I used it. And, you know, if you noticed, the day that it opened, we ticked up to that 66 area. Technically, you know, it worked. There was resistance there. We basically had a double top, and that's been my swing trade.
May I add a couple of points, Anthony, here?
Absolutely.
Yes. The first one basically is what we are seeing right now is just by using the yuan in China, risk increased. And the reason why risk increased, because what you are adding to the oil contract is the risk of the exchange rates that everyone has to carry. So risk is higher. And then you are carrying the risk of all the changes in monetary and fiscal policies in China that are associated with it. The second point is what we are talking about basically can be tested easily over time, because all we got to do, just look at the correlations between the prices in yuan and the correlation between other markers in the region, like Dubai and Oman, for example, and then look at WTI and at Brent, and see over time whether there is this long-term correlation or not. If there is long-term correlation, then again, it just kind of revenues in yuan. That's what it is. There is no pricing in yuan.
Gotcha. Yeah, Anas, you made a great point. The risk increased with the exchange rates. Now, Tracy, I want to go back to you because I know that you watch the euro for when you're trading crude. Are you watching the yuan now when you're trading crude?
So, I mean, as far as, I don't watch the currency like USD, CNY. It's not a currency that I follow. I don't think this contract is going to fundamentally change the oil market as much. I think that it'll find its equilibrium and it'll be priced, among the different grades. Because you have to understand, WTI, Brent, and this contract, they're all different grades of crude. So I think it'll find its equilibrium. But initially when it came out, I knew that there were going to be, I thought they would try to sink it and with additional risk. So that's how I used that particular event to make a trade decision. It has changed the dynamic of how oil trades at night a little bit, but that's, but it's still new. So, I'm still kind of keeping an eye out to see how much of an impact it's going to continue to have.
No, yeah, that's a great point. I mean, looking at it at night, that's when I think it probably will have the most impact. You have U.S. markets closed, then you have, Chinese markets open. So, yeah, I think that's definitely something to keep an eye on. Hey, everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. What was one of the hardest things that you've had to overcome in trading?
Not to be stubborn. You fall in love with an idea, and that idea, it's a bias. It's a bias that stays inside your mind. You become stubborn. And at the first moment in which I realized that I trade what I see and I trade not what I imagine, I'm not stubborn at all. I'm a believer, but until a certain point. And the other part gets back to what I said before. I learned not to look for long movement in derivatives, for short movement, loading up, period.
How has your trading evolved over the years?
Okay, my experience swung as a pendulum. I was, one time I was 100% fundamentalist, and then I was 100% technical analysis. I evolved during the years, trying to find an acceptable and balanced mix among the two. Which is, of course, this is a job in which you never stop studying, neither learning. And, of course, has to be improved again after 20 years, but this is it. I'm evolving that way.
What's the number one resource you spend your time on?
Price action and my model. And my little tools, my very simple little tools that I use.
What's your favorite book about trading or the markets?
Pitbull by Marty Schwartz.
What's your favorite movie or TV show about trading or the markets?
Lately, The Big Short. Long time ago in the 80s was Wall Street.
What's the best piece of advice that you've received about trading or the markets?
Trade what you see, do not forecast, and be prepared.
If you can give a piece of advice to the new people interested in getting involved in trading, what would it be?
Analysis. Get your homework. Trade what you see, know what you imagine. Never forecast too much. And one trade after the other, one day after the other, and cut your losses immediately.
Okay, I want to go back to Danielle. Danielle, I'd like to talk to you a little bit about the yield curves. I know that you watch them, and as we sit, I think that like the 530 sitting just above 30 basis points, and the 210 is somewhere around 43 basis points. They continue to flatten, so I'm wondering what you think about that. And I'm also wondering what you think that the FOMC is thinking when they see these yield curves flattening the way they have been.
Well, Powell said it in his press conference. He is paying attention to the yield curve. So, they're not completely blind to it. John Williams gave a speech in Spain today where he said he anticipates there being an easy glide path to getting the Fed funds rate to 3% by the end of 2019. And again, you have to ask yourself, what planet is this man on? Why does he think that he can thread that needle if he's talking about the Fed funds rate itself being above the 10-year yield as things stand? And that means that Fed policymakers believe that they can generate some upside in yields on the long end of the curve. I think that with $237 trillion and counting of global debt levels, that the yield curve is communicating to us loud and clear that the last thing that the world economy and the overabundance of debt that's been created since the financial crisis, the last thing it can handle is higher long-term interest rates.
Mark, I go back to you again for the execution side of things, getting the insight from Danielle and what the Fed is looking at and with this yield curve flattening. What do you make of it? What do you think about this flattening yield curve? And once again, what decisions are you making or changing based upon a flattening yield curve?
Yeah, look, I think the yield curve is a great indicator of the belief in the Fed's activities, whether the market believes that the Fed is achieving its goals, or whether it's making a policy mistake. And I think you can hear it screaming loudly and clearly that every time they've raised short-term rates, the yield curve doesn't steepen. It actually gets more flat. And we're on the verge, as Danielle just mentioned, of pushing to an inverted curve, which would push us into recession, which I actually think is a good thing. I mean, I have a hashtag, hashtag make recessions great again. We need recessions. We need to shut down the bad businesses that have been extended credit like zombies and the zombie apocalypse that's coming. So if you look at the short end of the curve, it's been spiking. The long end of the curve has actually been falling slightly. So we're getting flatter and flatter and flatter. And I think it's entirely unlikely that long-term rates are going to rise. In fact, one of our big surprises and our Morgan Creek surprises this year is that, you should, like Willy Wonka said, you should never, never doubt what no one is sure about. And everyone on the planet is sure interest rates are going to rise. We actually think long-term rates are going to fall, and you might want to be buying long-term treasuries here.
You mentioned a lot of things that I want to talk about right now, and one of those things I want to focus on first is the curve flattening. Now, I watched the 210 very closely. 75 basis points was something that Ira Harris pointed out to me, and I thought when that got broken, that was going to hurt equities. It didn't happen, and now the curve continues to get flat. What are you watching? You said that that was a concern of yours. What are you watching in the 210 or even the 530 as it gets flatter that all of a sudden you feel that is going to have an impact on equities?
Well, it's interesting. So the common refrain that you'll hear is that there's going to be a level at which the 10-year reaches that's going to be some red line in the sand that's bad for equities. And I think that's misplaced. I think when we think about that, remember back in the February time frame when we had the quick 10% sell-off, and that was due largely to the fact that we had a strong average hourly wage number in the January jobs report, and we broke through some resistance level on the yield on the 10-year, and everyone was talking about the 10-year getting to 3, and and that was going to be the death knell for equities. I think that was the wrong way to look at that, and I think that we can easily live in a 3.25 yield on the 10-year. And not be negative for equities. And, the old argument is always, well, there's a level at which the yield or the safety trade on the 10-year would start attracting equity dollars and conversely slow down the economy with the cost of doing business and the cost of borrowing money. I think what's more concerning is the fact that our 10-year seems to be much more anchored to what global sovereigns are trading at. If you look at the European 10 years, obviously, because of their current state of monetary policy, they're yielding much lower. So, we're still finding that bid for our 10-year, which is keeping us anchored at something south of 3%. What gets concerning is we don't control the 10-year, but we are certainly having an effect on the 2-year, and the 2 years affected a whole lot by our impression of monetary policy. So that's why the flattening is starting, and it's increasing. Same thing is reflected in the LIBOR, U.S. dollar LIBOR rate, which is going up even faster than the 2 years. So whereas we control what's going on on the front end of the curve, we don't control what's going on the belly of the curve, and that's where it gets concerning, because there's so much leverage in the system right now. The tighter that gets, I don't think that a flattening yield curve is going to signal a recession. I think it may well cause that recession.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.